Hello and welcome to video 4 of the Licensing Education Series by AIC, a partner of American Senior Benefits. Please watch each video all the way through once without taking notes, and then go back and take notes. You'll find that you retain more information that way. If there are any topics you would like me to do a deeper dive into, please comment to tell me the specific information you want me to go over. Thanks for attending, and let's get started. So, as I mentioned in the previous video, there are two classifications of life insurance, term and permanent. Today, I'm going to go over the first type of permanent life, which is whole life. It's the oldest and most common type of permanent life insurance. And as the name says, it's supposed to cover a person for their whole life, although policies will end and pay out, which is called endowing, at either age 100 or 121, depending on the company and how the policy was designed. That's because the cash value keeps going up until eventually the cash value equals the face value, at which time there's no longer insurance, so the company just pays out the benefit. So, let's say a person has a $100,000 policy, and they're paying premiums every year, and that cash value keeps going up, and eventually that cash value is going to grow until there's $100,000 of cash value in the $100,000 policy. Well, there's no insurance at that point. So at age 100 or 121, however it was designed, they're just going to go ahead and pay out the policy owner that cash value, which is the same as the face value, and that's called endowing. So unlike term, which is pure insurance, the whole life builds cash value. So the amount of net insurance, which is what the insurance company owes a beneficiary, that amount of net insurance goes down over time. So for example, if the client had this $100,000 policy and they're at the point where there's $50,000 of cash value and the person dies, well, the beneficiary will still get the $100,000 death benefit, but $50,000 of it would come from the cash value, and $50,000 of it would come from the insurer. Now, this cash value amount, that savings component that's in whole life, that's one of the reasons that there are a couple companies and some celebrities that are kind of against whole life. They feel that term life is a better option because they don't feel that using whole life as a savings component is a good use of your money. So there are three types of traditional whole life, but whichever kind you get, they will all have a level premium, a level face amount, and a guaranteed cash value. Since it has cash value, the client can usually take a loan, withdraw cash, or use the policy as collateral. So they can get loans against the cash value. They can take the cash value. Or they can use it as collateral on another loan. They also usually have other living benefits like terminal illness or critical illness waivers. I'll get into those kind of things in a later video, but these living benefits, the loans, the collateral withdrawals, the waivers that you can have on that, that's one of the reasons people do like whole life, is because it has those extra benefits as well. So the kind of whole life that you're probably most likely to be familiar with is straight life, which is also called ordinary or continuous premium life. Straight, ordinary, or continuous premiums, all the same thing. This is the kind that you pay premiums for the life of the policy. It has a level death benefit, and it gains cash value until the age of 100 or 121 when it endows. So how does that look? There's a level death benefit. There's a level premium. And the cash value grows from nothing until at age 100 or 121, the cash value equals the face value, and it endows. The second type is what's called limited pay or limited payment, whole life. They're usually written as some form of X pay, where X is the number of years that you're going to pay a premium. So for example, a 20 pay, the client would pay premiums for 20 years, at which point the policy would be paid off. It can also be designed to pay premiums until a certain age is reached, like 65, for example. If the client didn't want to pay premiums after they're in retirement, they could design it to pay off and then not have to worry about that. In these policies, the premium's higher, so that more money goes to pay for costs early on, which then pays for premiums later. The cash value also grows faster up front than later on. So how that looks is this. You still have that level death benefit, or face value. You have a premium, but instead of it lasting all the life of the policy, you pay an increased premium for a shorter amount of time, like to say age 65 or for 20 years, whatever. Cash value still grows, but it grows a little differently, and then it grows faster until you stop paying and then slows down. And then again at age 100 or 121, cash value equals a face value, and it goes ahead and endows. All right, and then the third type of whole life is single premium whole life. With single premium, instead of paying a regular periodic premium, the client would pay one lump sum payment up front. Now this type's a great way of transferring wealth. Instead of having, say, $100,000 in the bank to leave the grandkids, the client could purchase a single premium whole life and instantly increase the value, bypass probate, and leave the benefit tax-free. They also have immediate cash value to use for living benefits. So how's that look? Well, still have that level death benefit, or face value. Instead of paying premiums, though, regular premiums, you still have just one premium that you pay. It's a lump sum. Let's say they put $100,000 in. They could instantly grow that to, say, $130,000. It really depends on the age of the person and their health, but let's say it increases by that. Well, now instead of giving the grandkids $100,000, you're giving them $130,000. And instead of everybody knowing your business, it now bypasses probate and goes directly to the beneficiaries tax-free. It still gains cash value accumulation, and then still at age 100 or 121, if they're still alive, then it would go ahead and endow to the policyholder. So those are the three traditional types of whole life. There are variations built on whole life platforms that don't follow the rules. The first one I'm going to talk about is interest sensitive. Interest sensitive whole life uses a fluctuating interest rate, which is used to either increase or decrease the premium within limits if it's what's called a current assumption policy. Or it causes the cash value to gain excess interest in an excess interest policy. And then that excess interest accumulates in the cash value, and those extra gains are either withdrawn to spend, or they're used to pay future premiums if they aren't withdrawn early. So how does that work? Well, so in the current assumption, you have the face value, level face value. You have a premium that you pay. You have cash value accumulation. But the cash value accumulation grows based on some other, a fluctuating interest rate, which is based on something like maybe the CPI. So if it's gaining more interest, then that extra interest is credited to the premium, which would lower the premium. If the interest isn't doing as well, then you would have to increase your premium to make up the difference in what that interest would be to cause the cash value to grow steadily. There is an upper and lower limit to that premium, though, so it'll never go to zero or some really high premium. It'll fluctuate within a certain range. In the excess interest model, you still have that level face value, and you still have a premium to pay, and the cash value still grows. The difference is the premium doesn't necessarily grow in a straight line because there may be extra crediting to it. However, the client either needs to withdraw that extra interest rate or credit the extra interest to the premium to pay future premiums. Because it still needs to grow until at age 100 or 121, the cash value goes to face value and then it endows. So that's the first kind of variation. The second kind of variation is called economatic. And economatic whole life, it's a life insurance, a whole life insurance that has a term rider attached. And the whole life policy part will get dividends. Now, a dividend in insurance is not the same as a dividend in the stock market. A dividend in insurance is a return of premiums the client has paid for a policy due to a mutual insurance company having excess profits or surplus. Mutual companies are owned by the policyholders, so the policyholders get the money when the company does well, versus stock companies which don't give dividends. Their profits go to shareholders. So anyway, when the dividend is paid, it is used to buy a paid-up addition. As the policy buys paid-up additions, the term rider is lowered by the same amount so that the face value stays the same. This also causes the premiums to drop over time. So how does that look? Well, it's actually has a whole life component and a term component. And this whole life gets dividends. And every time the dividends build up enough that it can buy a paid up or paid off whole life policy, that's what it will do. So every time there's dividends, it'll add a little bit of whole life. And it'll keep adding whole life until this term, it keeps going down. And since these are paid off, there's no premium for them. So that term component decreases, the term premium decreases, and so overall the whole premium decreases, and it becomes more and more whole life, which generates cash value. Okay, so the last type of whole life that I'm going to go over is senior life. Senior life is also known as final expense life. These policies are usually sold to clients over 50, but under 85, although each company designs its own life insurance, so that's not set in stone. There may be companies that sell it under 50 or over 85. And there are really 4 different flavors of senior life. The first type is level. And level looks just like our straight life over here. So it's got a level death benefit or face value. It's got a level premium, and the cash value grows and ends at age 100 or 121. And it pays out from day one of having the policy. Usually the maximum on these type of policies is around 30,000, although I see companies that have them up to 50,000. It's not set in stone, just like the age range isn't. Each company kind of designs its own policies. But just remember, it's restricted to some certain age group and has some kind of maximum face benefit. It also has what's called simplified underwriting. It just means it's easier to qualify for this coverage. And since it's easier to qualify for the coverage, where you don't have to have doctor records or have a physical or anything, since it's easier to get, usually the premiums are higher than it would be to get a straight life. But they're also faster because you don't have to wait on all that stuff. So usually you can get it with some companies, you can get the decision on this policy before you leave the client. The second type that I'm going to talk about is called graded whole life. Now, graded whole life works similarly, except for the fact that in the first year, the death benefit is only going to be maybe 30% of the full death benefit, and the second year is going to be 70%, and then a third year on, it would be 100% of the death benefit that's paid out. So the reason it's called graded is this death benefit slopes. And another word for a slope is a grade or gradation. So it's graded 30. Now these are also not set in stone. It doesn't have to be a 2-year. I've seen 3-year periods. I've seen variations on 30 and 70. But just understand that the face value will go up over the first couple years until either 2 or 3 years in, it will pay the full death benefit. These policies are usually sold to someone who has some moderate health conditions that wouldn't be able to qualify for the level senior life or a straight whole life policy. The third type is modified. So modified, again, it works similar to level, except that the death benefit in the first year is usually the premiums paid plus a percentage, like for example 10%. In the second year would be 2 years of premiums plus some percentage, like 20%. So that would look like this, where in the first year it'd be premium plus 10, and then premium plus 20, and then the third year that'd be the 100% of the death benefit. These policies are usually sold to people with more serious health problems. There's also a fourth one called guaranteed issue, and it looks like this. Again, in the first year it'd be premium plus some percentage, second year it'd be premium plus some percentage, and the third year and on 100% in most companies, although I have seen 3-year modified and 3-year GI policies. Guaranteed issue, there's no health questions. Anybody can get it as long as they're alive, they can get the policy. So these are the most expensive. Those guaranteed issue, that's the most expensive of any of these types of life insurance. Don't be surprised if you run into policies that have different grading periods or different minimums and maximums or different ages. Each company, again, they come up with their own, so there is variation from company to company. Also, don't be surprised if other agents or even trainers call graded or modified by the wrong name. I've even seen some company documentation where someone calls a policy by the wrong name. The easiest way to remember graded is the sloping benefit. Is to think of like a road grader. I'm sure you've seen one. It's that big, long, usually yellow tractor that has a blade about halfway down its body. And if you see construction work, they drive along and they're scraping the dirt off. Or if you ever lived on a gravel road, they'll come down and they'll scrape the road, the gravel down, and that's used to grade or slope things. Like, they grade the road so the water runs off. All right, so that is whole life. The next video is going to be on flexible life insurance. Please like and subscribe so you'll get notified when new educational videos are released, and thanks for watching.